Markets don't move on what's already known, they move on what's coming next. And right now, Wall Street is holding its breath after weeks and weeks of record highs, it feels like. Today's pause feels less like weakness and more like anticipation. Everyone's waiting on one man, one decision, and one set of projections that could redraw the roadmap for the economy. So we're flashing back a little bit, but on Monday, the S&P 500 closed at its 26th record high of the year. The Nasdaq hit its 26th record close, making its best September in 15 years. Today, the momentum cooled down a bit. We've seen the Dow slip 0.27%, the S&P 500 dipped 0.13%, and the Nasdaq eased 0.07%. But even with the pause in markets we've seen today, enthusiasm remains sky high. A Bank of America survey shows global fund managers are the most bullish since that of February. The share of managers overweight stocks doubled from last month to 28%, even as a record 58% admit that equities are overvalued right now. It's the definition of holding your nose and buying at the same time. Cash levels dropped to 3.9%, while expectations for economic growth saw their largest jump since that of October 2024. Managers also shifted exposure, piling into healthcare, telecom, and consumer discretionary stocks while trimming positions in energy, utilities, the United Kingdom, Eurozone, and emerging markets. That bullishness comes with contradictions, though. While managers are overweight equities, they saw the biggest risks ahead as a second wave of inflation, which was at 26%, the Fed losing independence or the dollar debasing at 24%. And meanwhile, the most crowded trades remain the long winner, the Magnificent Seven tech giants, long gold. So right now, yes, investors are chasing growth, but hedging with history's oldest safe haven, which is gold. Now, one reason stocks haven't cracked despite the job market weakness is consumers. Consumers are still spending, allowing this economy to be seen as resilient. So August retail sales jumped 0.6%, double that of Wall Street's expectations. Autos were a large contributor here. Online spending and restaurants also surged. Clothing and back to school categories rose 1% because we're in the month of September, right? So school starts in September. Everybody gets ready in August. Now, while sporting goods and bookstores gained 0.8%, so a little slower there. Even after stripping out autos, retail sales were up 0.7% compared to the expected 0.4%. And perhaps most telling, restaurant spending climbed 0.7% in August and is up 6.6% year over year. That's often seen as a barometer of confidence. People don't eat out if they're worried about losing their job or if their pockets are, on the weak side, dusting out the cobwebs. But it's not all strength, though. Future furniture sales fell 0.3%, which is a tariff-sensitive sector that shows the strain of higher import costs. And remember, inflation did pick up again in August, back to 2.9% year over year, which is the highest we've seen since that of January. And that's where the Federal Reserve comes in tomorrow at 17 hours, 34 minutes, 26 seconds. So tomorrow at 2 p.m. Eastern time, the Fed will announce its first cut since December. The CME Fed Watch tool puts the odds at around 96.1% chance of a quarter cut. That's essentially locked in. We're essentially guaranteed that we're going to get a cut of a 0.25%, 25 basis points. But here's the real market mover, the dot plot. So this is the Fed's quarterly projection showing where the policymaker sees rates at the end of this year, next year, and beyond. But back in June, the median expectation was for 2 cuts in 2025. After weak labor data and downward revisions, some now expect the Fed to come out and pencil in 3 cuts this year. That shift from 2 to 3 would signal a clear pivot toward more aggressive easing. Now, tomorrow we'll circle around 3 core questions that everybody's going to be wondering. How concerning is the slowdown in job growth? Because that's been quite the headline for some time now, that job market. Job creation has weakened, unemployment is creeping higher, and revisions show the labor market wasn't as strong as thought. And that leads us into the second question. How quickly should rates fall toward neutral? Neutral being the level that neutral stimulates nor restrains the economy. Now, where exactly is neutral in this environment that we're in? And that's the hardest to pin down because we don't know if that's 3%, we don't know if that's 2.75%, or even lower. So Jerome Powell will try to thread the needle at his 2:30 press conference tomorrow. Too dovish, the markets may fear inflation risk. And if he's too hawkish, think about how hawks they're like flying around looking for a mouse or some type of food to eat. They squeeze it with its with its little feet. So think about a hawk choking the economy and trying to like slow it down, like, oh, stop spending. Kind of like Homer Simpson on The Simpsons. Every time Bart gets in trouble, he's like choking them out. But if he's too hawkish, Wall Street could punish stocks for expecting more than the Fed's willing to deliver. Now, a quick reality check. The last 10 trading days of September are historically the weakest stretch of the year. Going back all the way to 1928, the S&P 500 averages a negative 1.1% return during this period. And in the first year of a new administration, the average loss deepens to negative 1.58%. So while record highs have investors euphoric and there's a lot of optimism out there, seasonality argues, hey, just have a little bit of caution out there. Be careful. Set stop losses. So putting together everything we've talked about, stocks are at record highs. Consumers are still spending. Fund managers are piling into equities while calling them overvalued. It's kind of questionable. Inflation is sticky, the labor market is weakening, and tariffs are still a wild card that we don't know what the heck can go on with that. But hey, at least the TikTok ban has been extended or delayed. What's it called? Taco? And tomorrow, a Fed decision that could set the tone for the entirety of the year. Will Powell give the market 3 cuts they're hoping for, or will he stick to just the 2 and risk disappointing bullish investors? The answer drops tomorrow and markets are bracing for it. Be here tomorrow. We'll talk about what all happens. And thanks for hanging out with me, y'all. Always love learning with y'all and presenting what I'm finding. We got a lot of news happening, a lot of moving pieces, and all we can do is come here together, learn, hang out, and see what happens. So in honors of the Fed tomorrow, cheers.